What's up, guys? Welcome to my channel. My name is Lyra and I am a Florida realtor at Century 21 Edge. Today I am chatting with Jackson from Fusion Home Loans. He's going to give us a little bit of information on what a first-time home buyer needs to be able to get qualified for a loan.
Yeah. Hey everybody, and yes, good to be here. So I think the three things mortgage lenders really look for, especially with first-time home buyers, but it pretty much qualifies for everyone, is credit, income, and assets. So those are the three biggest buckets that we look for, and those are the three biggest hang-ups that I typically see.
Okay, so I know a lot of people are wondering if they can get qualified if they have bad credit, because it seems very common these days. A lot of people do have bad credit. Tell us about like the range of the credit score number that you want to see, or like how does it all work?
So typically, the way we look at it is there are thresholds. So once you pass this number in your credit score, you get certain, I don't want to say breaks, but it helps with your interest rate and qualifying for different products. So you could, as low as 580, be accepted for a plethora of loan products. But once you hit 600, that's a lot better than 580. And then honestly, the next one would probably be 680, would be a big threshold there as well, because some even investment products, like your DSCR product, we have one where your minimum credit score is 680 there as well. So even if you're in the low 600s, you're still very, very solid and very good to go. I would say that 600 mark is the biggest threshold on qualifying versus not qualifying.
Okay, cool. So then what does it look like if someone is just around that 580, just barely making it?
So what I would do is I would look over that credit score, or that credit report I should say, and see if there's anything small. If it's just, hey, let's just take 2 months and pay off this credit card, so your credit utilization goes down. That can increase your score dramatically. So I would look and see if there's any small targets that we could look for and do it ourselves. And if there's not, if it's something that's going to be a little bit more intensive, 4 to 6 to 8 months, then I would either work with you to repair that credit, or if you're more comfortable going with a credit repair company, we could do that as well.
Okay, so what if someone's at the lower end of that threshold, but they don't want to wait, they want to buy a house right now?
It would depend on assets, the third of the three things that I brought up. If they have money to pay off credit cards, because there are some where you won't even qualify for a product if your credit score doesn't fall within their range. So it doesn't matter if they're Bill Gates, if they have too low of a credit score, they wouldn't qualify.
Okay, so then let's talk about maybe a scenario that someone has a good amount of money saved up for a down payment, but their credit score is maybe in the 400s. So would that be sort of spend some time with the credit repair company, or like what would that look like and how long would that take really?
So 400s is tough, because that probably means there are definitely a few derogatory events that have popped up on there that dropped it, whether it's a foreclosure or repossession of a vehicle or a long history of missed payments. So those are probably the three biggest things, or bankruptcy, that would also tank it as well. So that would be more of a long term. So it depends. If it's a bankruptcy or foreclosure, it depends on the recency. If it was within 7 years, then we may be able to do something, depending on what chapter bankruptcy, which we don't have to get into all that.
I'd actually love to hear about that. I'd love to hear about these different things and how they affect your credit score.
So basically, the Chapter 7 and Chapter 11 bankruptcies, they're a little bit different. So Chapter 7 bankruptcy is 4 years. Once it's past 4 years, then you're good to go. It's as if it's, think about serving a sentence at a jail. So you've shown that you can now repair your credit on your own or make your payments, and you're no longer looked at as a higher risk. And so with your Chapter 11, that term is 7 years. So now you have to wait 7 years before you're able to get a mortgage, basically.
Okay.
Through a traditional, not a hard money lender that doesn't look at anything like that.
Well, what's that all about?
That is just individuals typically who are less risk averse, and they'll charge higher interest rates because they don't go through the normal traditional channels that a bank or a local lender or a broker would go through.
Okay.
So that's an avenue for people that aren't, I guess, fit into the traditional box of purchasing a home. So maybe someone had something a long time ago, 4 or 5 years ago, a pretty bad foreclosure or a bankruptcy, but they came into a lot of money. So if they try to go through a traditional avenue, let's say, they may not be able to qualify. But another avenue, which we do not do, unfortunately, is hard money lending. So that's just another, I guess, option for some people that have the money to do it.
Nice.
And I will say it is typically a lot higher of an interest rate because you're not going through a federally funded or mandated company. You're going through an individual usually. So that's just one more aspect too. Yeah.
Okay. And then why don't you tell us a little bit about the interest rates right now? Because I know that is something that people are seriously concerned about.
That's something people are always seriously concerned about. But yes, so we have had, it's basically been very tied to the interest rates, have been very tied to the international affairs that have been going on. So as someone bombs someone, interest rates in oil raise. And as peace talks and volatility slowly decrease, then you'll see a lot more comfortability within the market, which translates to lower interest rates. So I would say the national average for a 30-year fixed rate is, I believe it was like 6.45, 6.5-ish this morning. So we were in the 6.8s a few weeks ago, so we've slowly trended downward, and hopefully we'll be trending downward.
Yeah, well that's great. I hope so too. Hopefully it keeps on going down.
Yes, everyone would be happy with that.
So the interest rates would affect your monthly payment, right?
Exactly.
Yeah.
I will like to actually bring up one point, because a lot of buyers are going to be sitting on the sidelines saying, oh yeah, Lyra and Jackson were just talking about hopefully those interest rates go down. I'm going to wait until insert interest rate number here. So if you think about it, a lot of other people are going to be looking to say, okay, when rates get below 6%, that's when I'm going to get serious about home buying. But so many other people are going to come out of the woodwork when that happens. So things that happen when a lot of people flood the market, buyers flood the market, is competition increase. So now that person with the 400 credit score or the 590 credit score that's right on the cusp of qualifying, they are no longer as likely to purchase a home because they're going to be competing with someone who's putting 20% down, who is a lot more confident of a buyer, someone that, not that your sellers ever see a credit score, but overall there's more competition, so those less qualified buyers typically have a harder time qualifying and winning in a multiple offer bidding war. Does that make sense?
Yeah.
So competition increases, prices typically increase, and those are two big things that your less qualified buyer may want to keep in mind, because they're saying, oh, my interest rate's going to go down a little bit. I'm going to save $60 a month, but they also might miss out on their dream home. So.
Okay, got it.
Yeah.
So yeah, you don't need to wait for interest rates to go down. Buy a home.
Yeah. Well, sometimes you do, but reach out to a mortgage loan originator like myself to see where you stand.
Right.
How about that?
So what were the other two things
So
that you
yes,
mentioned?
income and assets. So we already talked on credit a good amount, more than I even intended, but we got into the nitty gritty. Income. So the next biggest qualifier is income. Are you going to have an income stream to pay for your mortgage for the whole loan term? Because we're assessing risk. That's what we do day after day. So is the credit, do they have a history of paying people back? That's why we look at that, because we're going to be lending out a large sum of money. Then the income, can they pay that loan throughout the loan term? Are they going to default? So we just want to make sure. The biggest, I guess, subtopic of income would be your debt to income ratio. Have you heard of that qualifier before?
I have, but why don't you go ahead and explain it to us?
Yes. So for different products, there's different thresholds on what number is too high. So your debt to income ratio takes in your estimated housing payment, so what that mortgage is going to be, as well as other monthly liabilities, such as a car payment you have, credit card payments and things like that. So they add up all of those debts and compare it to your monthly income, and typically like to see under 50%.
So even if you have a lot of income, your debt would have to be on the lower end.
Right, like let's say you make 10 grand a month and you have a $3,500 mortgage. So in order to get to 50%, if you have less than $1,500 in monthly liabilities, you would most likely qualify based on the income. I can't go off of a whole file, but on the income side, that's what we'd be looking at.
So what I'm curious about is, because I work with a lot of 1099 independent contractor people, so how does that play in to what they would need to qualify as opposed to like a W-2?
Yeah, so I'll start with
is that right?
Yeah, I'll start with the W-2 because that's a lot easier, and I'll check that off, and then I'll compare that to the 1099. How about that? So W-2, we would typically look at your last 2 years of income, or your employment, I should say, which we're going to do that with 1099 as well. But we would just look at the last 2 pay stubs, or 30 days of pay stubs, to see if they're making what they said. That's us verifying those self-reported data. And so you look at their taxes, look at their pay stubs, and from there say, okay, they make X amount a month. If they have a salary, that's super easy. Just divide that by 12 and you're on your way. And then hourly, that's when all the other calculations come into play. So that would be how we would get that income. Very simple. We just look at a couple documents, make sure that they've worked in that industry for about 2 years. That's what we like to see, just for congruency. Because if they...
So I had a question about that, the 2 years. So what if you had changed jobs quite a bit? Maybe you have a consistent income coming in, but it's not necessarily with the same company.
So company isn't the biggest driver or influencer. It's more so industry, because now let's say someone has worked at, I don't know, name an industry and a company in that industry. Here, I got one. Okay. Let's say someone's worked at McDonald's for 5 years, right? And then they switch jobs and work at Burger King, and they've worked at Burger King for the last year. Nothing dramatically changes switching from McDonald's to Burger King. But let's say you worked at McDonald's and all of a sudden you work at NASA. That's a big industry shift.
Right.
So this goes all back to risk assessment. Are they going to be in that same industry for a long time? Is they just changed from something they've been at for a long time? Now, if they switch jobs, are they going to keep their job? We want someone who's worked at the same place for a long time, and we know they know what they're doing, and we know that they're going to keep their job for the life of the loan. Make sense?
Good to know.
Good to know? All right, but I'm actually going to switch right over to 1099 now. So that's pretty easy, cut and dry. Look at the taxes, look at their pay stubs, get their income compared to their liabilities. 1099, we also look at 2 years of taxes, obviously. And I would say the biggest difference between W-2 and 1099, it's very easy to have that quick conversation with W-2, look at the pay stubs and move on. I like to have more of a conversation with people in the 1099, whether they own their own business, they've been an independent contractor for however long, and see, okay, what are you doing? How do you generate business? Because I'm a 1099 employee, and as are you as a realtor, so we're both independent contractors, and we have a lot less of a stable income. Typically. I mean, there are some W-2s, you can lose your job. There's no such thing as 100% stability. But we have less of a naturally flowing and progressing income. Like a salary, you slap that on a pay stub and you're good to go. Here, it's like, okay, do you have slow months? Do you have busier months? Do you make most of your income seasonally? And we have questions like that where we really dive in, where do you get your clients? Everything like that. So that's the biggest difference there, is it's a lot more of a conversation, and then actually figuring out the pricing is different as well. We're going to look at the past 2 years of taxes and your income that they reported. So there's one right there. Reporting self-reported income and what you report on your taxes. A lot of people, understandably so, don't want to pay Uncle Sam as much as they have to. So they'll underreport their income, which is great. They save money during taxes, but it also hurts them on qualifying for a loan. Right. So there we have personal bank statements that combat that, because we just look at the business bank statements there and we can generate income through the company, or just using their personal bank statements to show that they have this income coming in. Does that make sense?
Yeah.
And so from there, we look at that. So whether we're doing a bank statement loan, which would totally is a 1099 product. That's great for people that, independent contractors, people that don't own their own business, and they might not look like they make a lot of money on paper on their taxes. That's perfect there. And then you can still obviously qualify for your conventional loan. We would just have to make sure that your income has been increasing or staying the same. So if it has been decreasing, we have to take the lower of the 2 years of incomes that we got, which usually hurts people. So that's where that conversation comes in, and it's what happened to your business? Why are you decreasing? Oh, I had employee move, or he started his own company, or whatever that looked like, or clients made my main account retired, or whatever that looks like. We try and figure out exactly where that business stands, because their income is tied to that company and that business. So if they are declining, then we have to either go bank statement or see what's going on and get the whole story. But it's more of a conversation rather than just looking at a few documents. Obviously, I have a conversation with all of my buyers, but it's less intensive with a W-2 compared to your 1099.
Got it. All right, well, let's move into the last third topic, or did we?
Assets.
Assets.
Yep.
Yeah.
So, biggest myth I would say is everyone thinks they need 20% down to purchase a home. There are obviously your VA and USDA, that's 0% down, 100% financing. First-time home buyers get a little bit of a break on the conventional side. So the minimum down payment for a conventional loan as a first-time home buyer is 3% compared to your standard 5%.
Pretty good.
Everyone else. And then FHA is 3.5% down. So many 5% down and less programs for you, where you don't have to save up as much as you think. You don't need $100,000 to purchase a home. So start small. There are down payment assistance options as well.
I want to hear about that.
Okay, let's hear. You want to just start rattling off stuff about down payment assistance?
Yeah, because we want to know.
All right, yes. So in Florida, actually, this is very what's the word I'm looking for? Great on the times. Like, this product is it's a seasonal product. Hometown Heroes. It starts in summer and usually ends around March-ish, February-ish, depending on how long the funds last.
Okay.
So it's a government-funded program. Usually starts at around $50 million, and it's for people like nurses, first responders, firefighters, police officers, educational workers, so your teachers, even a janitor at a high school or a college, your professors, all of that good stuff. So a long list of employees has to be working at a Florida-based company, so they have to have a brick and mortar in Florida. But 0% interest on it, and up to $12,500, I believe, towards your down payment and closing costs. So
that's great.
I mean, almost $13,000 can help a lot of people end up purchasing a home. So if you're interested on that, please reach out. It's a great product. So basically they release them, I believe, July 13th. And once they're all reserved or utilized, the program's over until the next year.
Okay.
But fear not, there are plenty other programs that offer right around the same type of financial support and interest rate and things like that. So just because it's the beginning of summer, you're like, oh, that lender guy said it starts at the end of summer. There are other programs across Florida and other states, but we are very, very good at what we do in Florida, especially with down payment assistance. We're approved by so many of those programs that offer them. And yeah, I mean, there's a lot of great opportunities for people to get involved.
So what about the people who they don't have any of those jobs, but they still want down payment assistance?
That's a great question. So yeah, it would be qualifying just like you're qualifying for a mortgage. Myself and my team, we actually qualify for that certain down payment assistance program as well, because each one is different. There are income limits based on your county, credit limits as well. So that's where your person with the 580 credit score might not qualify for the 640 minimum. Granted, it ranges from program to program, but that would be another limiting factor for someone. It's like, hey, they're not going to give out this money, this down payment assistance, to someone who doesn't have a good history of repaying loans or any borrowed money.
Okay, so let's say a 1099 person wants down payment assistance.
That's totally fine.
We
We would look at it the same way as a W-2. Check step 1, is their credit fine? Step 2, do they have reserves? Do they have assets? Which typically they don't if they're doing down payment assistance. A little bit of a tongue twister, can't even say that. And then we would qualify their income the same as I just went over it. So making sure their income isn't too high. And
what's like the cap, you know?
County to county. Orange County, I believe Hometown Heroes is like $126,000 a year.
Okay.
Don't quote me, maybe 124, but that range. So very reasonable. It's not like if you make over 60 grand, you're not gonna qualify.
Okay.
So, yeah, and then there are some other nitty-gritty guidelines that I would have to refresh because it's been a while since I looked at Hometown Heroes. But the biggest one would be employment, and then the second biggest one is they can't take offer letters. So you have to be physically already working for that company. So like for a W-2, 1099 is a little bit different because that would be more like contract work. But let's say someone just got a offer letter for a hospital and they're moving from Georgia to Orlando. We can't use that stated income that they're going to make, even if it's guaranteed hours and guaranteed salary. Like we could qualify income based on that for a regular loan, but Hometown Heroes does not take up others.
Got it. Cool. Well, I feel like we learned a lot today about what a first-time home buyer would need to qualify for their loan. If you guys are looking to buy or sell anywhere in the US, I can help you find a home or list it. Just hit me up. And if you're looking to buy and sell in Florida, I'm a licensed Florida realtor.
Yeah.
And Jackson?
Yeah, we're nationwide as well. So I believe we're in 40 states now. So I like those odds. So reach out if you need some financing questions or help purchasing a home.